Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. In this special episode, we have two very special women leaders from the ETF industry to celebrate the International Women's Day. In the first part, I'm joined by Perth Toll, founder of Life and Liberty Indexes. Perth created the index for the Alpha Architect Freedom 100 Emerging Market ETF. Ticker symbol is FRDM. And while China accounts for more than 30% of the portfolio and most popular broad emerging market ETFs, Freedom ETF excludes it. It also has no exposure to countries like Russia and Saudi Arabia, all countries that have poor freedom and human rights record. And we know that Russian stocks have cratered in the past few days. Chinese stocks have been beaten down over the past 1 year or so. So Perth's ETF, which doesn't own any Russian and Chinese stocks, that has significantly outperformed the broader emerging market indexes. So with Perth, we will discuss investing in Russia, China, and the importance of freedom weighting. In the second part, my guest is Leah Wald, CEO and co-founder of Valkyrie, which is a financial firm focused on digital assets. They have over $1 billion in assets under management, and they recently launched a very interesting, the first of its kind ETF that provides exposures to miners, Bitcoin miners, that primarily use renewable energy. And with Leah, we will discuss the investment case for Bitcoin miners, and Valkyrie ETFs. So joining me now is Perth Toll. Perth, welcome back. Great to have you on the show.
Great to be back. Thanks for having me.
So let's talk about the Russia-Ukraine crisis, and our thoughts and prayers are with the Ukrainian people. We can just hope that this very tragic situation ends soon. But this is an investment podcast, so we need to talk about this crisis from the investment angle, and particularly about Russia, which has become some sort of a global pariah. So in addition to these crippling financial sanctions by the US and its Western allies, most major companies, including the biggest ones, Apple, Microsoft, Google, they have either decided to suspend their operations in the country or pulled out entirely. And investors are ditching Russian securities, which are fast becoming almost worthless. Moscow's stock markets remain closed for several days now, and almost all Russian ETFs, which were trading in the US, trading in them has been halted now. These ETFs had plunged last week. Major index providers like MSCI and FTSE Russell have announced that they would remove Russian stocks from their emerging market benchmarks. So I was interested in your thoughts on Russia from an investment angle. Has the country become uninvestable?
Yeah, so that's actually it's a little bit different when you're talking about Russia and other countries that I've been asked that question to, like China. So Russia has literally become uninvestable from the standpoint that it is not even trading. So stocks are not trading. There's no way to get price discovery on them except through ETFs, which are now also not trading. And the currency is extremely volatile. So it is literally by definition uninvestable. Now there's the other type of uninvestable, which is it just is there so much investment risk that maybe a company like us or certain investors would consider it uninvestable, but it's not literally uninvestable. So that's more in the case of China. I've been asked this question about as well, and that's because of the autocracy risk. So the autocracy risk exists in more than one country, not just Russia. It's much bigger in emerging markets indexes when it comes to China. But yes, Russia right now, I would say, is both by autocracy risk standards and also by just literal standards completely uninvestable.
So let's talk a little bit more about China too. Chinese stocks, particularly Chinese tech stocks, they have been beaten down due to regulatory crackdown in the country. And if we look at the China Tech ETF, KWEB is the most popular one. This is down about 65% over the past year. But there are many investors and experts who continue to believe that this is buy the dip opportunities and Chinese stocks are too cheap and all that. So that is why this ETF has actually gathered $8.3 billion over the past year when it lost 65% in terms of performance. And if you look at China, China has a lot of exposure to Russia and Ukraine too. And they recently said that their economic growth target at around 5.5% for the current year, which is the lowest since 1994, the lowest target since 1994, when they started setting these GDP growth targets. And the economy looks weak in China, the housing crisis and all that. Consumer spending is going down, and they have these zero tolerance COVID lockdowns, which again affect the country. So what are your thoughts about China being uninvestable, the second scenario that you mentioned, and what would you tell people who continue to say that China is a buy the dip opportunity?
So just relating it to the Russia example, the time to divest from Russia was not right now. It was before it became completely uninvestable, right? So with China, it's the same scenario, except it's a much bigger risk. Russia was 3% in most emerging markets indexes, and China is close to 40%, so 35+% in most emerging markets indexes. And that is set to grow as they become a bigger part, the A shares become a bigger part of inclusions with MSCI. And China's overall allocation is set to get to around 50% of the emerging markets indexes. So that's a lot of concentration in one market, but that's what you get with market capitalization weighting. So the risk there is, as you mentioned, China did come out with a lower growth projection than they had in the past. But even that projection, I'm not sure we can trust, because this is a country that doesn't have the basic, freedom of speech, freedom of media, freedom of expression in place. So they can't actually say anything that the government doesn't like, and that includes things like GDP targets and other types of company level data. So if we can't trust the data, and remember, this is one of the countries, China is one of the countries that refrained from voting to condemn Russia in the UN meeting recently. They were one of few countries that did not want to comment and condemn Russia. So if you are not even free to make that symbolic gesture, how can we trust the data out of this country, right? So first you have to have reliable data, and I don't think we have that in China. But let's just assume that that data is correct. Let's assume that all of the GDP targets are going to be met. Even in the past 40 years, when the GDP was growing tremendously, if you look at an index like MCHI, which is China onshore and offshore shares, since 1992, which is the inception of the index, the annual return has been about 3.3%, when China grew tremendously over that time period, GDP-wise. So you can see that's an abysmal return for foreign investors. When you're in a place without rule of law, without investor protections, and without strong institutions, investors don't necessarily participate, even if there's growth in that market. So that's why we believe China is not really a buy the dip opportunity right now. In fact, since they're committed to reversing all of the economic policies that made them prosperous in the last 30 and 40 years, and they're carpet bombing all their industries now and have no regard to the economic impact of their policies, we think that China is a growth story of the past, and it's going to be a major drag on emerging markets indexes going forward.
So you're right about Chinese data. It cannot be trusted. And even that data, the current projection shows that the growth is slowing down over there. Now, your index, which is the freedom weighted index, it is called the Freedom 100 Emerging Markets Index. You created this index. This has excluded China and Russia and all other autocratic countries. So tell us a little bit about what exactly is freedom weighting and how do you define freedom?
Yeah, so freedom weighting is basically an alternative way to weight emerging markets as opposed to, say, market capitalization weighting. So instead of getting this autocracy heavy concentrations in the world's worst human rights offenders, like we do with the market cap weighted indexes, with freedom weighting, you get a much higher weight to the freer countries, lower weight to the less free countries, and no allocation to the worst offenders like China, Russia, and Saudi Arabia. So we define freedom by, we use quantitative freedom metrics from third-party think tanks. So I have no influence as to what those freedom scores or freedom metrics are, but I turn those metrics into freedom weights. So the metrics come from the think tanks. And we use the Cato Institute and the Fraser Institute. And they have a data set that includes both personal and economic freedom. So it's things like terrorism, trafficking, torture, women's rights, freedom of speech, media expression, civil procedure, criminal procedure, political process, economic freedom, things like taxation, rule of law, private property rights, investor protections, soundness of monetary policy, and freedom to trade. So all of these things added together into a composite freedom score, which we then use to derive country weights and allocations. The worst offenders are naturally excluded out of the index by this freedom weighting methodology. And the higher freedom countries like Taiwan, South Korea, Chile, and Poland naturally get a higher weight. And then the rest of the countries get a lower weight based on their freedom levels. So it's 100% freedom weighted on the country level.
So that is how you select the countries that will be included in the index. Then how do you arrive at the companies that will be included in the index and held by the ETF?
Yeah, so it is a top-down approach, and the country weights, which are 100% freedom weighted, drive the security weights. So once we have a country that is included, we then choose the top 10 largest, most liquid securities within that country to include, and we exclude state-owned enterprises just to bring the economic freedom theme all the way through. So the less government intervention, the better. So with those top 10, we then market cap weight those within their freedom weighted country weights. And that's just to get a good representation of the market in each of these countries.
So your index excludes China and Russia, Saudi Arabia, because these are all autocratic regimes. It also includes India, I notice, which is another one of the largest emerging markets. So tell us why India is excluded. I was just interested. And what does it hold currently?
Yeah, so India is currently excluded. It was included last 2 years ago. India is one of those borderline countries. So there is no 100% free or 100% oppressive market. So even the US, obviously, we have our problems and democracy is messy. And then even in the very repressive countries like Russia, you still see people are still able to walk out on the street. They're able to buy food. Some of them are protesting, although getting arrested. So there is still a slight level of freedom. So there's no 100% freedom country or 100% oppressive country. It's all relative. And so the methodology uses the relative freedom level against its peers for inclusion. So as long as India is above most of the emerging markets, as far as their freedom level, they're included. And when they're not, they're excluded. So this is one of the countries when they were not above the average. So 2 years ago, India was included. And then in 2021, they were excluded because of three things. One is they had some repression of their Kashmir peoples. And two is they had more than previously interfered in the media. And 3 is they blacked out the internet in places that had protests. So because of those 3 things, their score dropped that year, and Brazil was included instead. So you can see when one drops, another one gets added in, even though Brazil's score didn't change that year. And then this year, India continued to be excluded. So it is because of those 3 things. Also, on the economic freedom side, India does have some issues as far as they have a lot of trade barriers, tariff and non-tariff trade barriers. But other than that, those are the main issues in India. I have high hopes for India, and I hope that they get included back in soon. But they are one of those kind of borderline countries that you never know what's going to happen.
And I'm looking at the top holdings. So what gets included in the index and the ETF, it seems Taiwan is the largest country in terms of weighting. And looking at the holdings, Taiwan Semi and Samsung Electronics, these are the top holdings. Could you talk a little bit about some of the top holdings?
Yeah, so Taiwan Semiconductor and Samsung, they're such large holdings in their markets. And of course, they're the world leaders in semiconductor chip technology. And so they have kind of an advantage in the market right now because of that. They are so large in their markets that we have to cap these companies, or they would be like together 30% of the index. So we do cap holdings at 8% at time of rebalance, but those 2 are the top holdings. And then MediaTek is another top holding. That's another semiconductor company in Taiwan. So we are very heavy in semiconductors. And then other than that, you have some banks in Central Asia, in Chile, in Poland. Poland is one of those countries that has a lot of state-owned banks, so we do exclude those. We have no state-owned enterprises. So then, and then I have a mining company in Chile, which is actually one of the few holdings that are doing well right now during this whole debacle. So we do have a lot of diversification within 10 countries. Right, actually this year we have 11 countries. It's not always 10, and 10 holdings per country. So it is very well diversified. We do have a little bit heavier tech exposure, but that comes from the semiconductor companies.
Excellent. So I was looking at the performance, and the ETF has significantly outperformed the broader emerging market indexes. So this is up about 37% since inception, whereas the broader EM indexes, which have a lot of exposure to China and also a little bit exposure to Russia and Saudi Arabia and other countries too, that has gained about 22% during the same period. So when you created this freedom weighted index, did you expect that freedom weighting would really drive alpha to this extent? So are you surprised by this outperformance?
Yeah, no, I expected outperformance, but over a longer time period. So I am surprised that it happened this quickly, but I think that's because we've had a lot of extreme events like coronavirus and like this Russia intrusion into Ukraine. So freer countries, and our thesis was that they would perform more sustainably, they would recover faster from drawdowns, and they would have better use of human and economic capital and less capital destruction. So we did see that play out. They are more sustainable in their growth, and because it's real growth, it's not state mandated growth, and the companies in these countries have the freedom to act in their own best interest and the best interest of their shareholders instead of the best interest of the state. They did recover faster. If you look at the recovery in the second half of 2020, the freedom weighted strategy outperformed broad EM, ESG, and even EMX China. So it wasn't even just China. So we're glad that that played out. And then you see they have less capital flight and capital destruction. You see all this capital destruction that happened last year in China. Not only can they experience capital destruction on the shareholder side, but also there's policies in these countries, like taking China again as Exhibit A, the one-child policy, which affected my generation a lot, led to 30 million missing women in China. And so one of the things that we don't always, as investment professionals, pay attention to are things like human capital and human capital destruction. So that's one of the things that has caused China to experience, now the worst demographics in the world. And a lot of emerging markets have these kind of weird policies that can cause these things. So that's something that we pay attention to as well. And so all of these policies, checks and balances on government power and things like that can help or hurt a country's future going forward. And so we try to capture the premium of the countries that have the conditions in place for growth. And we believe that personal and economic freedoms set those conditions.
Very interesting. Now, that is about freedom, but we know that ESG investing is one of the hottest trends in the investing world lately, and ESG ETFs have seen some massive inflows over the past few years. So do you think Russia, China, and Saudi Arabia, and also such autocratic countries, they should be excluded from ESG ETFs, emerging market ESG ETFs, mainly on moral grounds?
I do, but I also, not only on moral grounds, but if you look at the investment case, right? A country that doesn't have basic freedoms like freedom of speech, freedom of media, there is no independent verification for the data that comes out of those companies or out of the governments in these countries. So without that first level of freedoms in place, you don't have any basis for any other ESG data. So on that ground, I would say yes. Countries have to first have freedom, and then we can talk other ESG. But if you look at the G, which is currently, in our industry, we're looking at company level governance. Let's just take, diversity, for example. You can have, women on the board. You can have things like maternity leave policies. But in these countries and emerging markets, especially, I mean, we're talking about things like, do women get killed for being born a girl? Do they get shot at for going to school? Are they allowed to drive or to exist? And so the issues in emerging markets are completely different from the types of ESG that we look at on the company level. And then there are a lot more foundational to a country. So for those reasons, yeah, I believe that ESG strategies, above all other strategies, should look at freedom, personal and economic, or at least personal for ESG investors, when they consider what countries to invest in. And not only that, but freer countries are, they're correlated with higher, income per capita, higher life expectancies, higher gender equality, lower infant mortality, lower poverty rates, and lower corruption. So all of these are better ESG outcomes. Once you have that G in place on the country level, the E and the S, you're mostly going to be pretty good on.
Makes a lot of sense. I totally agree with you. Congratulations again on FRDM's excellent performance, and thanks for joining us today.
Thanks so much for having me, Nina.
So that was Bert Toll, founder of Life and Liberty Indexes, and I'll now be joined by Leah Wald, CEO and co-founder of Valkyrie. Leah, welcome. Great to have you on the show.
Nina, thank you so much for having me.
So tell us a little bit about yourself and Valkyrie and what got you interested in digital assets.
Sure, absolutely. So I am the co-founder and CEO of Valkyrie Investments, which is a digital asset focused investment manager. My background is really in economics. I originally began my career at the World Bank. I also worked for Vital Financial, whereby we were advising multi-billion-dollar asset managers on global macro strategy and LBO strategies. And I really started in the Bitcoin industry in about 2016, working for Lucid. So Lucid Investment Strategies was an RIA that was a specialist in trading the security of GBTC, which provided exposure for our discretionary accounts in Bitcoin. But it really, was a foray for me to, work within the asset management industry with my passion of Bitcoin. which really actually spans all the way back to some of the early days of Bitcoin. When I was at the World Bank, I was working in the Sub-Saharan Africa region for former Vice President Obiazek Wesley. And at the time, that region was highly focused on a technology called M-Pesa, which did microfinance loans, SMS-based. So when I first learned about Bitcoin in around 2010 and 11, it made complete sense to me from an economics perspective. I had already seen that this type of technology could work, and I could see how the development of Bitcoin specifically from reading the white paper made sense as an evolutionary development from what was already being done with, M-Pesa, Grameen banks, and other initiatives like that. So it was a great opportunity in 2016 with Lucid to really be able to merge both my worlds of asset management and finance with Bitcoin. And I've been working as a Bitcoin asset manager ever since.
You have a very interesting background, I should say. So let's talk about Bitcoin. And we saw that Bitcoin rallied in the last week, but it remains well below its all-time high of about $69,000, which it had reached last November. So last week, when it was rallying a bit, people were saying that the rally is being driven mainly by Russians converting their cash to Bitcoin, and that was to evade these crippling financial sanctions that have been imposed on Russia. Now, talking about Bitcoin over the past few months, we have seen that it has sold off with other risky assets, particularly high growth stocks. So in theory, since you mentioned that you are an economist, cryptocurrency bulls used to say that Bitcoin is an alternative asset class and it should have low correlations with stocks and other assets. But we have seen actually cryptocurrencies are closely correlated with risky assets, and particularly during market volatility. And cryptocurrency bulls also said that Bitcoin can be digital gold, like an asset which can serve as a hedge against inflation or economic uncertainty. So I think that case has kind of fallen apart. Bitcoin did not serve as a safe haven during rising economic uncertainty or rising inflation. Gold, on the other hand, has actually been outperforming, particularly since this crisis in Ukraine escalated. So from an economist point of view, what is the best investment case for Bitcoin now?
It's a very good question and a very astute observation that I would agree with, especially its correlation with risk-off assets. In some situations, such as the Russian invasion of Ukraine, which you mentioned, we have seen that dramatic spike in Bitcoin buying among many of those that were affected. But we at Valkyrie currently feel that Bitcoin still is too volatile to be considered a safe haven, or as some in our industry like to call it, digital gold. Right? That isn't to say that it won't fulfill this prophecy in the future, but right now we're still in the early days of the asset class and see it more as a frontier asset than an established commodity like physical gold. So I think you're absolutely right. The correlations are very specifically apparent, and it is still nuanced, though, in how they react to different environmental or regional factors, whether it's Russia and Ukraine or previously last year with China and mining. There's always been regional and geopolitical triggers that have caused the Bitcoin market to react very specifically and differently than traditional equities. But I would say that you're correct that they still do act as a risk asset and should likely be treated accordingly. But I think that what's important to understand is that this is still a very young asset class. So whereas that's the case now, it could definitely be different, 5 to 10 years from now. So I think it's prudent to watch as it may or may not evolve into more of a store of value and digital gold or inflation hedge, as many have believed it to be having that capability in the past.
So you recently launched a Bitcoin mining ETF, and this is the first ever ETF that provides exposure to miners that primarily use renewable energy. And the ticker symbol is very interesting, WGMI, which stands for "We're all going to make it." So that's so relevant in the current scenario for cryptocurrency investors. So I don't think that many of our listeners, I think most of our listeners and myself included, we don't exactly understand how Bitcoin mining works. So could you please explain what exactly is Bitcoin mining in simple terms?
Absolutely. It is complicated. It's also the element of the industry that excites me the most. I think it's fascinating. So I will start with what it is not. Most people think of Bitcoin mining simply as the creation of new coins. And this is part of the process, but there is a lot more to it. So, very simply, miners validate transactions on the blockchain, and the blockchain is a public digital record similar to a ledger. So that's almost, the full simplicity there is that miners solve algorithmic equations in order to validate transactions on the blockchain.
Very interesting. Now, I read an article in the New York Times recently, and this said that the process of creating Bitcoin consumes about 91 terawatt hours of electricity annually, which is more than is used by Finland, which is a nation of about 5.5 million people. So why does Bitcoin mining consume so much electricity, and your ETF focuses on renewable energy? So talk to us a little bit about the focus on green energy in your investment strategy and why so much electricity consumption.
Yeah, absolutely. And I think that some of the media narrative focused negatively on Bitcoin electricity consumption is actually a bit off. First of all, as an overall market sector, Bitcoin miners are leading the way on renewable energy with adoption rates hitting 58% of total electricity consumption, which is, in opposition to 31% for the broader US electric grid. So you can already see. You're absolutely right, though. This fund, we're all going to make it, which is a meme, is 77% of the energy consumed by the companies in the fund does come from renewable sources on a portfolio weighted basis. So it's definitely a lot. What's interesting is, again, to your point and to what the media has noted, in the past, there has been a very high reliance on non-renewable or green energy sources for that electricity for Bitcoin mining. But it's been a stark shift where miners have relocated to places with abundant renewable energy sources that include wind, solar, hydroelectric. That's in, upstate New York, Texas, Washington State, Wyoming, Canada, many other places. So it really has shifted. And I think that it's important that Valkyrie and others start highlighting the real integration of green energy that's being done by Bitcoin miners so that we can kind of combat that narrative that some in the media have highlighted that I think is more past rather than present and future.
So when we talk about gold and gold miners are considered leverage plays on the metal. For example, gold is up about 1.8% today, and the most popular gold mining ETF, which is by VanEck, that is up about 2.6%. So do you see a similar relationship between Bitcoin and its miners as well? Are they leverage plays on the digital currency?
That's exactly right. It's actually shown that Bitcoin miners have outperformed the price of Bitcoin historically in the past. And so it's a very interesting and unique play, and obviously very equity based. So, especially for investors that may feel uncomfortable knowing how to analyze or lack thereof Bitcoin marketplace from the spot perspective when it comes to the miners. These are public companies that are listed on the TSX, on NASDAQ, on publicly listed exchanges, and all of their financial data is exactly the same as any other equity. So it's very easy to decipher the fundamentals as well as the technicals. So it's an interesting opportunity similar to the ETF that you pointed out, whereby, again, you're able to analyze it. And also, it's an element of the industry that has shown that it can outperform even the underlying.
So I'm looking at the holdings currently, and it is an actively managed ETF. So the number of holdings will change frequently. It has 21 holdings currently, and the top holdings, as you would expect, are Bitcoin miners like Bitfarm, CleanSpark, Hive Blockchain, Argo Blockchain. But I also see chip companies, semiconductors, NVIDIA is there, Taiwan Semi is there, Samsung is there, AMD is there. So talk to us a little bit about the holdings in this ETF, the exact investment strategy, how holdings are selected and weighted, and why do you have chip companies in there?
Yeah, absolutely. There's only so much I can speak to legally on that front of the portfolio construction. However, thematically, you're absolutely correct. There's 4 of those companies are chip makers that are specifically making chips for Bitcoin miners. It is an actively managed portfolio, so our portfolio management team is always looking for the companies that he believes will make for the most efficient and optimized portfolio. So we felt that it would be prudent and important to leave that opportunity to also include chip makers, which have historically also outperformed and done very well, especially during bullish time periods for Bitcoin and underlying.
So is the universe of Bitcoin miners, the publicly traded Bitcoin miners, is that large enough and liquid enough to be, to have an ETF based solely on Bitcoin miners, and that to Bitcoin miners that primarily use the renewable energy sources?
Yeah, we believe so. All the companies in the fund are, as mentioned, publicly traded and all have significant volumes across the exchanges from NASDAQ to the London Stock Exchange and the Toronto Stock Exchange. And they're held to the same reporting standards as other public companies. So we do believe that that is enough to make for a sophisticated portfolio that's specialized, to this thematic.
So you offer 3 ETFs, and one of them is a futures-based Bitcoin ETF. And this was the second Bitcoin futures ETF to be listed in the US. So we have seen that there was initially a lot of excitement about Bitcoin futures ETFs also. The first Bitcoin futures ETF quickly gathered over $1 billion in assets. But after that, your ETF and the ETFs that came after that, they have been struggling to gather assets because it seems that investors really want a physically backed Bitcoin ETF, which is not futures-based, because futures have the rollover costs and other costs as well. So there's a lag between the performance of the cryptocurrency and an ETF that uses futures. I understand that you have a filing for a spot Bitcoin ETF as well. Do you think the SEC is going to approve a spot Bitcoin ETF anytime soon?
Yeah, we are of course hopeful that a physical Bitcoin ETF is a reality soon, but we aren't holding our breath. The regulator has genuine concerns around the accuracy of pricing and volume data and possible market manipulation. And the outright rejection of several spot Bitcoin ETFs have been on those grounds specifically. That said, the conversations we are having with authorities have been very collaborative. They've shown a genuine curiosity in learning about our industry and getting rules and regulations right. So we do welcome the opportunity to help educate and help in the creation of rules meant to encourage innovation rather than stifle it. You're also correct that when the Bitcoin futures ETFs launched, it was ProShares and then Valkyrie, and then after that, Van Eck also launched a product. So the three of us have Bitcoin futures ETFs in the market right now. There was definitely a lot of fanfare. I think what's interesting right now that we're still seeing a good amount of demand. Even our Bitcoin ETF was the 14th largest ETF launch in the US. However, to your point, I think a lot of investment committees and money managers are looking at how we are executing with the roll costs, with tracking, and therefore trying to get more comfortable with these futures products. However, the futures products are using CME listed futures. So it's a very comfortable product and vehicle. I think that it just will take a little bit more time for everyone to understand that these products are a great opportunity to buy exposure to Bitcoin. But I think that, again, that will happen over time. That will take a little bit longer. And we understand that. And that's why, we are also very actively in conversations with larger money managers, RIAs, to ensure that they understand the granular nature of how these vehicles are constructed. But as of right now, they're the only option in the market. They're great options, but they are the only option in the market for a Bitcoin ETF until spot gets approved, which likely won't be soon.
Okay. And we have seen that those spot Bitcoin ETFs have been trading very well in Canada and in Europe. So we can just hope that we will see a spot Bitcoin ETF in the US as well. Leah, that was a very interesting discussion. Thanks so much for joining us.
Thank you so much for having me on.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.